Tens of thousands of Canadians could default on their mortgage, according to a bank CEO. How much trouble is there in the Canadian real estate market right now? I'm going to be breaking that down in this week's reaction video. And the second article we'll be talking about is Mr. Toronto Mayor John Tory is going to increase their taxes in the city by 5.5%. Uh-oh, what's that mean? Stay tuned. Now, if you are looking for some help on how to navigate this real estate market in 2023, whether you're on the offensive or the defensive, you can book a call with me using the link that's on the screen. It's right here, www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making awesome educational real estate content just like this one for you. And the first article that we'll be reacting to is tens of thousands of Canadians could default on mortgages due to rising rates, bank CEO says. Great headline. Toronto Star. Nailed at it again. Back at it. So let's kind of go through this, right? The first thing I'm going to highlight to you is the person that's talking that sounds like they're the most, I think, bearish and most vulnerable is the CEO of Scotia, saying about 20,000 of the bank's borrowers could be vulnerable, which represents about 2.5% of the bank's mortgage customers. Now, you have to keep in mind how some of these mortgages work at each of the big banks. Scotia is the only one in all the big banks, so not counting RBC, CIBC, I'm missing some TD and BMO, that actually have the interest move up and the payment move up when the Bank of Canada increases their interest rate. So they're on an adjustable mortgage, meaning it doesn't stay the same. So most of the people that have a Scotiabank mortgage would have felt a lot of the increases in the last 7 rate hikes that we saw in 2022 already. So if there was any default, Scotia would definitely be the first to see it because their payments have gone up. That's number one. Now, one of the things that I would say is if you're not Scotia, your payment has been stuck, and they talk about that a little bit later in the article, but essentially they hit their trigger point. We talked about this. Most people are negative amortizing. Now, one of the things that I personally like to point out to you is this little segment here where it says, on top of that, millions of the bank's other boards are likely to face financial pain this year as they renegotiate fixed rate mortgages on higher monthly payments on variable loans. Now, generally, before all this crazy interest rate stuff, the most common mortgage has been a 5-year fixed in Canada, just because that's a Canadian thing to do. And if you go back 5 years, the people are renewing right now that got a mortgage in 2018, which is around 2 to 3%. Now, the lowest mortgage I've seen to date is like a 4.89 3-year fixed, which some people are opting to take right now. So which is much bigger than some of the 2018 rates that most people have gotten. So there is going to be kind of a sticker shock for people who are renewing. Now, the question becomes how many people are going to be at risk, right? So if you bought a home in 2018 and now you're renewing, you're most likely going to be in a very equity positive position, right? Unless you refinance. And in case you refinance, you're technically not renewing, right? So you're equity rich, but you have to make sure your income can sustain that new higher amount. So what a lot of people would do if they can't actually make that new income because they would have already paid down the mortgage, say for 5 years, what they could do is they could actually extend that 25 years that they're coming up to back to 30 to make the payment. So I don't think that there's going to be a lot of like major risk coming. What's going to happen is a lot of people who have multiple mortgages are going to be the ones that are more likely to sell. And like I've been saying for like last few videos, no one knows how many of those people are out there right now, right? Now, one of the things that I think are going to be a little bit of issue because the banking regulators haven't talked about it is when you go to a different bank to renew, they have to stress test you again. And because the rates are so high, most people from maybe 2018 may not qualify for the stress test right now. So it locks them into that bank because when you have an existing bank and they tell you to renew, it's generally just mailed to you, you check the box and you're good to go. But what not being able to shop around does because you can't qualify for the stress test is that you're now stuck with that bank and that bank could ream you if they wanted to. And that's kind of non-competitive, but you know, that's just banking problems in Canada. So I would like to see the banking regulators change that a little bit. But at the moment right now, there's a little bit of some unfairness that could be at play right now. And I have seen some of my clients renews come back at like 6%, which I think is a little bit outrageous, right? Now, the next thing that I have highlighted here that is the CEO of RBC thinks that the new wave of mortgage defaults won't seriously impact their bottom line. Now, you're going to come out and say, a lot of these bank CEOs, that a certain percentage of their books are at risk, but they're also going to say that, hey, look, our numbers are still good, we're still making money. So you're catering to the shareholders so that the value of your stock doesn't go down, but at the same time, you're kind of pleading to the banking regulators saying, hey, look, help us out. Because you have to remember, the bank's job is to create money, right? I'm not going to get into that, but create money in the mortgage space, lend it to you, and earn a spread on the money that you create, because they pay a percentage of interest, you pay a certain percent, and that spread in between is their profits because they make money. So in the instance where they're trying to appeal to the banking regulator saying, hey, look, we need some controls in case something crazy happens, we need to be protected. And then on the other side, they're also saying, hey, look, our bottom line isn't affected. Just talking it through both sides of their ears, I guess, if that's the saying. And it doesn't make any sense. So I generally would like to question that. The other thing I have highlighted here, and this is actually a really juicy article, that's why there's so many things I've highlighted. The CEO said that the household savings built up during the pandemic with the strong labor has basically saw a lot of the home values increase. This should provide a bit of cushion. And I do agree, but like I said, with mortgages, it really depends on when you bought it and if you're going to lose your job in this kind of potentially upcoming recession, downturn, whatever these guys want to call it, right? Because at the end of the day, remember, the bank's job is to lend you money and make money on that money. Now, this part is where, again, I also have some problems with, right? So it says, a lot of the people that they're concerned about, like these customers, tend to have low credit scores and own their homes are not worth much more than their mortgages. So what they're talking about is people who are underwater. So let me go through the train of thought in this for you, right? So these, I would say, are people who bought with less than 20% down. So in Canada, it's sub $999,999, so sub $1 million, more or less. And if you bought for, say, like 5% down after land transfer tax, you're probably underwater if you have to sell. So the banks are, if they had to take the property back and sell it, they're probably going to be losing money because the mortgage amount that they owe is likely negative from what the value of the property is. Because remember, in GTA, prices came down about like 15 to 17%, depending on which micro region you want to talk about. So if they went in there with like 5 to 7.5% equity, and now it's down like 15%, the mortgage is most definitely bigger than the value of their home. And that's what they mean by negative equity. So even if they sell the home, right, you can't pay back all the debt. And this is what the banks don't want, because they're now losing money for the money that lent out to you. But here's the catch to all of this, and this is why I have issues with this. The people who did less than 20% down are basically insured by CMHC or like Sagan, which means that if that person, like the borrower, defaults, the banks get their money back. So I don't know why they're kind of concerned about that, because either way, with an insured mortgage, the banks are going to win. Either you pay the interest, they make money on that, or you default and the insurance pays them, and then technically taxpayer money pays that out, right? But story for a totally different day. What I think I'm more concerned about is people who went in 20% and maybe they were in a different market and now that 20% is also underwater. So I think that's a little bit more of a concern than kind of the insured mortgages that are on their books. Now, the thing that, is a silver lining, and I've talked about this the first video I made this year about like trends to expect in 2023, video up here if you want. The number of Canadians who actually fall into arrears of these 3 months or more is at historically low, and it's hovered around 0.25 and 0.5% of mortgage holders, which is crazy low. So to jog your memory, this is kind of the mortgage delinquency rate that we've seen. You can see since 1995, it's the lowest since ever. So this is at 0.25. And remember, this is all of Canada-wide, so it's very, very low. But if you look at just Ontario-wide, I pulled the data for you, you can basically, Ontario is the orange line over here, and it's actually much lower than even the blue line. So we're at 0.1% of mortgages actually be delinquent. But again, keep in mind, risk happens fast, and this is always like 3 months behind because it's always delayed and how they're reporting it, maybe even 6 months, depending on when they actually issue out these numbers. But to give you a comparison, because everyone always talks about how, this is a 2008 US crisis waiting to happen. In US, they were about at 2.5%, and then they shot up to 11.5% really quickly, and then that's where we saw the housing crash. We're at 0.1% in Ontario, 0.2. We have to basically 10x to get to the baseline effect of before where US started the great financial crisis, and then they ramp up. So that's what I'm saying, like Canada's mortgage criteria and lending is stringent for a reason. It's strong, but it doesn't prevent it from having a lot of power sales. Now, the next snippet that I've highlighted is saying that for most of the people, they're saying that the average monthly payment is going to go up about $350 on a variable, or they may go about $700 a month. Again, I don't think that's going to make people lose their homes per se, but when you pile that on top of inflation and the cost of living, it may affect some people. But kind of like the delinquency numbers show you, people will cut back on a lot of things like vacations, fancy meals out, or whatever before they actually default on the mortgage. And this is kind of why I think a lot of the bankers are a little bit, not overly concerned about where we are right now. Because remember, they see way more data than what we do, right? Because they have like crazy books of all this stuff. Now, the other chunk here I've highlighted is that they're saying that the mortgage stress test has been kind of like a nice thing to have, because everyone at minimum was being stress tested at 5.25%, which is effectively kind of what the rate is right now. So all the people in 2018 who are renewing, right, if you can't like re-amortize or whatever, they would have technically been stress tested at the current mortgage rate already. So they, in theory, should be able to handle it. So that's why I don't think there's going to be kind of like a whole snowball effect of power of sales coming your way, because they've kind of, luckily enough, we stress test for it already. But it doesn't prevent, like I've been saying before, a lot of the alternative lenders and B lenders where they have a lot of power of sales because people put multiple mortgages on a property. So those are still at risk. But again, how many of those come to market? Nobody knows. Now, the two things here I have highlighted that I, again, am questioning is they're saying that 50% of RBC's variable rate, remember RBC, fixed payment, you're mainly paying interest now if you hit the trigger point. They're saying that most of them are no longer covering anything but interest. But the key thing about how each of these banks wants to navigate this is whether they're going to force you to make an increase or payment, or you can continue negative amortizing, meaning any excess interest rate that you aren't paying just gets added to your mortgage and you have to pay back, or we're going to kick the can down the line and it's going to affect you on the renewal side, right? So every single bank will have their own way of how to deal with this. And some may call you to increase your payment. Some won't care and just leave it as is, which is just kicking the can down the line. Now, my problem, and one of the things that they talked about is in this article, is the cash flow is there to absorb it and the collateral is there to absorb it to a large degree, meaning that they're saying that the people who have borrowed from them have enough money to cover it, which, yes, I agree. But here's what I will say. If you do make them increase their payments by, call it like multiple thousands of dollars, they may not have the cash flow to cover it. And also, if the asset in which you're lending against has come down in a certain price, you have no collateral. And that's what I'm saying. It's the bank's job to lend you money and make a spread on that. It's not their job to power of sale your property, recoup it. And even if you recoup it, there's not much money there. So they don't actually want to do that. And that's why I think the banking CEOs right now are calling out for some kind of like help from the bank. Because remember, the help from the government is to protect the bank, not you or I as the consumer. They want to protect the financial stability of the bank, not us, right? So they want to make sure they're okay, not us. And the final thing I want to point out to you in this article is that the head of OFC did come out saying that, hey, look, we're going to potentially review some of the mortgage underwriting criteria. Let's call it a stress test 2.0. I'm going to cover more about that on Thursday's video, so make sure you like and subscribe. Now, if you do like this content I'm putting out there and kind of breaking down the very intricate components of the mortgage world and how they're talking and how it's going to affect you, make sure you smash the like button and subscribe to the Prime Props channel, because I do want to kind of provide more context to some of this stuff and why maybe certain things are being said, because like I'm in the space and I know what kind of like different pieces are at play when certain things are changing, right? So I just want to kind of provide that, layman's kind of explanation for most people, because in most financial things, it tends to be overcomplicated, in my opinion. So hopefully that kind of gives you more understanding of what's actually happening in the real estate market and not just reading headlines. And if you are looking for some help on how to navigate this real estate market, you can book a call with me using the link right here. It's www.chatwithzen.com. Now, the second article that we're going to be covering is Toronto's property taxes to go up 5.5% as part of 2023 budget, according to John Tory. Look, I have no issue with property taxes going up 5.5%. Again, it's not going up to 5.5%. The multiplier is like 0.69 right now. It's not 10xing almost. It's saying that the amount of taxes you're paying is going up 10%. So how they're saying that is that a lot of the homeowners are going to see an additional $183 a year, which is really small. But how they arrive at this percentage is they see what their budget is, which is what I highlighted, and then they look at the assessed value of the properties and they just kind of change the multiplier of it, which is called the mill rate. So they need the budget to balance. Now, the interesting thing here I would want to say is there's a little bit of funny politics at play here, which is kind of why I highlighted. It says that the budget delivers on the promise, because you have to remember, John Tory ran on the platform. He won last year for not increasing taxes, right? So you can look at this article that was in October 24th. I've highlighted it, right? They don't want to increase it past the inflation rate. So the fact that the inflation is so high is giving a pass to increase the taxes on it, which again, I have no issue with, because when you have to pay people for the services like police, fire department, hospitals, etc., you should increase the cost to service these things because inflation comes at all that rate. The problem is people it's not very popular to increase property taxes, and that's why most people who are elected and officials try not to do it. But them doing it, I think, is perfectly fine. I just find it perfectly funny because they're saying that the inflation is 6.6% and they're only increasing it by 5.5%. So it is technically under. Technicalities. Love politics. Now, the interesting thing that I will point out to you, and I'm putting a chart over here, is that because the land transfer tax, when you buy a property, you have to pay the land transfer tax in Toronto, contributes such a large amount. When we went from 2021, which was record year in sales and volume, I think it was 60% higher than 2022. That was a lot of taxes. Now, when we went to 2022, when we had 20-year record lows in the last 9 months, give or take, the amount of revenue the city generated from the land transfer tax is really, really low. So last year in 2022, I think we generated 2.5 times less kind of land transfer tax for the city than the 2021 year. So when you have constantly these fluctuating amount of income coming in for the city based on just how much real estate is traded and the total dollar volume, we have a huge issue with the budget. Now, I don't want to get down the rabbit hole of where this money goes to, because it's billions I think they put away somewhere. But the idea here is Toronto is in need of more money if we're trying to grow as a city. And they're just basically increasing the property taxes so that they can cover a lot of these services, which I'm totally cool with. I know some people are going to object and they may not vote for John Tory, but thank goodness he's doing this at the start of his term, right? So hopefully this gives you an idea of what's happening in the real estate market, because there's a lot of stuff happening on the mortgage side. There's a lot of stuff happening on the city side as the real estate market is just starting to ramp up, because this was the first week officially, I would call it, of when people start transacting in real estate. It is still a bit slower than what the most Janus are used to, but it's definitely higher than what it was in December, and I'll comment on more of that on other channels, so make sure you subscribe. And if you're looking for some help on how to navigate this real estate market, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya! Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.